some stability in the markets, but you know what? We still have no greater clarity on the end game. The risk remains.
Thanks very much for having me on the program. It's great to see you both again. So let's take care of the easy conclusions first. The easy conclusions from a JPMorgan perspective are, number one, Evergrande is still likely to default. Number two, this is not a company-specific issue. This is a structural issue that impacts the entirety of the Chinese property developer space. Number three, this will not become systemic. To support that last conclusion, which is probably the most contentious of the three, I would suggest a couple of different numbers for us to look at. Number one, total outstanding commercial bank loans to the China property development space is about 10 trillion RMB. If I look at loan loss reserves on the balance sheets of Chinese banks, it's about 5.4 trillion RMB, and they make an additional roughly 2 trillion RMB a year. So unless you assume a massive default ratio on the entire body of commercial and residential property development loans that sit in China today, this is not a systemic risk. Therefore, we see potential buying opportunities in less levered developers with lower inventory levels. But we do not see this as a contagion risk for the rest of the region at all.
Not systemic, but is it time to rethink China's growth? I mean, if you take a look at property, it accounts for about 25% of GDP. That's massive.
And it's not just that. It's an absolutely critical question, so thank you for asking it. The right conversation to have on Evergrande is not the impact on the property development space. The right conversation to have with Evergrande, as you rightly hint, is the overall impact on economic growth, but also the structure of tax collection and revenue generation for the Chinese government. As we all know, a very high degree of revenue generation is driven by land sales. On JPMorgan calculations, that was roughly about 8 to 10 trillion RMB in land sales, primarily by local governments last year. Interestingly, there's this impression that China is such a centralized economy. From a government spending perspective, however, it's shockingly decentralized. And so those provincial level land sales are critical. If we are now saying that household formation will structurally slow, based upon a delay of marriage, based upon lack of fertility rates, based upon ultimately a falling population over the course of the next 10 years, then that revenue generation source is clearly in question. And so the right conversation to have here is what is the central government as well as the provincial governments going to do to restructure the entirety of the tax code to be cognizant of the structure of the Chinese economy on a go-forward basis. Also, as you very rightly say, construction has been a primary driver of the economy for many years. They lose that lever moving forward.
James, you're highlighting some of the structural shifts taking place. Why have they occurred in a bit more detail, James? And again, just a little bit of a read-through as to how that will affect growth looking forward.
Sure. So you can definitely say that the Chinese government loves its slogans. But the one thing that I would not do is to discount them as meaningless. And so when the Chinese government talks about things like common prosperity, those words have meaning, and that meaning is expressed in policy. And in this instance, you're looking at very significant rising levels of income inequality in China. And like most markets in the world, that's largely driven by asset differentials. 90% of Chinese are homeowners. You have a generation of Chinese that are beginning to believe that they will never become homeowners because of lack of affordability. And the government is in many ways justifiable in stepping in to start to curb that excess. One of the conversations that we've had with investors is the Chinese government has very clearly learned from the experience of Japan several decades ago, is looking to take the top off a housing pricing bubble and start to create a more affordable housing environment moving forward.
James, I just want to get a sense of, what happens next as well, with Evergrande and the like, because, I mean, some have likened this as Beijing orchestrating a controlled explosion, and one which sends a message to the wider property market and saying, you better adhere to those 3 red lines that we had, which, of course, target liability levels. You've got leverage and liquidity. In other words, do we then look for the next shoe to fall in the property market of a developer, let's say, whose liabilities are higher than 70% of its assets and net debt perhaps exceeding the value of its equity and short-term borrowing growing larger than its cash reserves? And those are the 3 red lines, essentially.
So Riz, I've always been a very firm believer in efficient markets, and I think in this instance we have a very clear example of that. And so while Evergreen publicly traded bonds are trading at about 20 cents to the dollar, we have a slew of other Chinese property developers that are trading at 40 to 60 cents on the dollar. And so the market, I would suggest, is cognizant of what you've just suggested. And as we said at the top of the program, this is not an idiosyncratic or company-specific issue. This is an issue that will face the entirety of this sector. And we need to watch those debt levels work out moving forward. JPMorgan baseline forecast is that we will see a more stable house price environment in China with significantly reduced volatility. And so we're not going to see the type of upside that we've seen over the last 2 decades.
James, what will the Fed say in your view, and does it move the dial in any way?
So again, let's take care of the easy stuff first and then talk about the more interesting bits. The easy part of the conversation, at least from a JPMorgan perspective, we will see tapering in November. We will see one rate hike in 2022. JPMorgan forecasts call for 3 additional rate hikes in 2023. And critically, we'll get the first look at the 2024 dots from the Fed governors in this announcement. JPMorgan forecast has 3 rate hikes in 2024 as well. So a relatively aggressive stance that does imply a steepening of the yield curve from where we are today and potential outperformance of both financials as well as cyclical stocks. The more interesting conversation, though, I think, is this battle that we're seeing across global markets between monetary and fiscal policy. In the U.S., you will very clearly see a rate cycle that will be more defined by the end of this week than it has been in some time. If I contrast that to what we're seeing in markets here in Asia, however, you're seeing significant fiscal thrust in markets like China and India. In both markets, you're seeing government tax receipts come in significantly ahead of expectation to the tune of 25 to 30%. In a market like India, that's translating to central government capex in the second half up 30% year on year, even more from state government up 37% year on year. So it'll be interesting to see how these dynamics play out.
So James, the thing is that the Fed has made it rather clear that announcing that they're going to be reducing their bond purchases, it does not signal they're going to be essentially raising interest rates anytime soon, which is a mistake that was made in the last taper tantrum, right? So they managed this pretty well. What do you think?
I think they have managed expectations quite well. The only caveat to that would be I do think that we'll see that increase that you just hinted at in terms of the potential for a 2022 liftoff and then an acceleration into 2023 and 2024. We are talking about dates, however, that are 2 years away. And so in terms of expectation management, we think they are doing a good job. The lack of volatility that you've seen in rates markets recently, I think, is a good sign of that.
James, I'm just wondering, what's your assessment of the taper risks? What will it take to derail the U.S. economy and get, the Fed back to square one?
I think if you see one of 2 things coming to the fore, one of the things that we've seen in our own JPMorgan economist estimates in terms of the strength of the U.S. economy is a significant reduction in GDP growth estimates as we've worked our way through 2021. The real key surprise here, however, is the fact that the services sector has not come back in a very significant way. And from a forecasting perspective, one of the things that we've looked at for the past couple of years are mobility statistics to try to better understand the impact of COVID on overall consumer spend. Historically, that relationship has been quite strong, but it is breaking down in a significant way. And at least at JPMorgan, we think that breakdown is triggered by a significant reduction in consumer confidence. And we very clearly see that in the numbers coming particularly out of the United States. If we do not see this transition away from the goods portions of the economy into the services portion of the economy, we could see the U.S. GDP growth missing expectations as we look forward into next year.